Good afternoon and welcome to this special edition of the Daily Energy Markets podcast, that one moment each month where we review what has happened the month before and look at what's happening in the month ahead. Joined as always by Mike Muller, head of Vitol in Asia, and Christophe Roule, a senior fellow at the Center for Global Energy Policy in Columbia University. Welcome to you both and thank you for joining us. This is a pre-recorded podcast which will broadcast at 10:30 UAE time on Saturday, recorded about 12, 16 hours before then. So just for those watching, have a context of time. Mike Muller, let's kick off with you. I mean, a month ago when we sat together, the oil markets looked a very different place, very fragile. The pricing had come off quite strongly after the OPEC Plus meeting. And I think we actually met on the eve of the OPEC Plus meeting. So the oil price was already taking a hit from the news from that. But the news came and the oil price collapsed. But it has since come back very strongly. A month out from the OPEC Plus meeting, your thoughts on the other sort of big events as to why that price recovered? Where do you see the health of the market supply demand at this point?
Yes, we're up $10 off the lows from 77 or thereabouts to $87.20 Brent $87.22 as we speak. And there are a number of factors, but the ones on everyone's mind are hurricanes, Hurricane Beryl in particular, which may already have peaked in terms of the concern factor. And I mean, not related to oil, of course, the elections, which form a backdrop, but the ones we're seeing right now don't have a bearing on the immediate price of oil. But then people's prognostications on forward demand catching up with supply, and people may be giving a little bit more credence than they did initially to the outcome of the last set of OPEC Plus meetings. So the market responded to the initial slump in prices by observing that there was a risk-off mindset and that managed money had essentially exited the energy commodity space. And that changed. So we've had a reasonably substantial inflow, and that has not just sent the flat price up $10, but we have a backward structure, which tends to fuel the interest in being long because you get the positive roll yield effect as you roll your front month into your second month every month. And that's a premium you're collecting, which at current levels exceeds the returns you'll get by investing in bonds or fixed term interest or whatever it might be. But there does seem to be a stronger sense of belief that fundamentally the supply demand equation in oil is likely to tighten going into, well, we're already in Q3, but going into the back end of this quarter, and particularly so in crude. On the product side, there's expected to be an adequately supplied picture. However, we still have the state of affairs where ships are going the long way around the Cape of Africa and avoiding the trouble spot in the Bab el-Mandeb, and that continues to see high inventories on the water, but not necessarily as high a set of inventories in the destination markets. There was a higher degree of concern on inventories in China and on the incentive to export, but of course that's limited by export quotas in China, and therefore there hasn't been any response to low prices, depressed fundamentals inside of China, flooding the market to quite the extent that we expected. And there are plenty of arbitrages open, which have seen yet more oil go onto water, even though inventories seem to have come off in recent weeks. There is a sense that there might be an increase again as we see large shipments of fuel and diesel travel longer haul. So an overall more resilient, tighter picture. And this is backed up by commentaries from expert advisory firms and advisory divisions of investment banks, where the range of estimates is still wildly apart. I mean, the range of estimates gives you a bullish picture and a bearish picture, but on average, the midpoint of those numbers is a slightly firmer consensus, and that's, I guess, why we're in the mid to high 80s now.
Christophe, I mean, the other big development, it seems, in the month of June and over the last few weeks in particular was a sense of clarity maybe emerging in the Fed's outlook. The idea that the US inflation challenge was starting to arrive at levels that would allow the Fed to start to cut. And that, of course, is also welcome news for the market. Your thoughts on that as part of the engine that has propelled oil prices now, we'd have to say, knocking on the door of 90 at well above $87 a barrel.
Well, as last month when we talked about, we had the oil price sort of coming out of its corridor where it was for a long time between say 80 and 85, falling out a little bit to the downside, and everybody blamed the OPEC meeting. Now we have it overshooting a little bit to the upside, and a lot of that is indeed due to sort of the economic environment in the US, especially the combination of two things: an increased expectation of interest rate cuts and therefore more economic growth, and this to be accomplished without a recession, which is what really matters to our market. So people now look forward and they price in, majority of observers prices in two interest rate cuts, the first one in September, shortly before the elections, which 2 months ago or so probably most people wouldn't have thought likely. And the numbers still indicate a soft landing. What we also have sort of for the longer term is this whole Biden disaster. And so if what's happening here is that in both camps, whether it's Trump or whether it's Biden or his replacement, it's likely to be a big spending government again. And before markets really get worried about the next wave of inflation or the big debt and fiscal deficit problems that brings, it will bring a boost of growth. And that also has kept oil markets sort of where they are right now. Plus, Mark has mentioned this already, the increase in geopolitical tensions, both in the Ukrainian attacks on Russian infrastructure, but also in the increased Hamas versus Israel artillery duels. And in the US, I forgot to mention, of course, the drawn inventories, which seems to underline that narrative of strong economic growth with lower interest rates and more liquidity in the markets in general, which that brings. So all of that, fundamentally, however, not much has changed. Fundamentally, if there is no escalation of either wars or some other big exogenous factor, we should still expect the oil market to sort of oscillate around that old corridor. There's no sudden increase in production or sudden jump or decline in demand or anything like that in sight. And it's more on the edges. And Mike said that the midpoint of expectations has moved. When I look at market observers, I think the midpoint has probably been for a long time somewhere in the mid 80s, but the noise level moves with falling a little bit above mid 80s or a little bit below the 80s. One side is more right than the other, and that continues without really a clear indication of change for now.
Mike, I mean, looking at the month of June, obviously the OPEC decision, the OPEC Plus decision, which came, obviously there was a collection of decisions that were made on that day in June, the first Sunday in June, where OPEC Plus agreed to roll over their quotas, their current production cuts, if you want, right through to the end of 2025. So added a whole year to that. So gave a real sort of outlook detail for the whole group, 22 countries, till the end of 25. Then they also agreed the 8 countries, which were the OPEC plus 8, the Great 8, I think the UAE minister called them, announced their decision to roll over their additional voluntary cuts, as they're called, by 1 quarter, this quarter that we're in now, the third quarter, and then by the fourth quarter to start unraveling those cuts. So I just wonder, and unraveling them by announcing that in great detail, month to month, for every one of those 8 countries. Firstly, I wanted to get your thoughts on the level of detail that they presented for the sort of 16, 18 months outlook to the end of 25, or the level of detail in the Great 8's unraveling. Your thoughts on that?
Yes, there was initially a mixed reception, if not a negative reception, to what by all accounts was a rather well-prepared meeting when they convened the inner circle, if you like. And because that led to a speculative sell-off in markets, because the markets had been presented with not one, but with multiple targets that OPEC Plus might then go and miss. It was rapidly followed up by a set of communications from key producers, which included some aspects that did show up confidence. For example, there are a set of countries that have statistically overproduced, and some of them were seen stepping forward and confirming to the media that they were going to observe a program whereby those overproduction figures would be corrected and those production numbers would be reined in order to restore the balances that OPEC Plus had pledged to see into the market. So that was just one of a few signals that came through, and it showed solidarity. It showed that there was cohesion because a significant number of those particular countries, some of them aren't particularly material in terms of total output, but the chorus was in unison. It was harmonious. It wasn't disharmonious, right? It wasn't a cacophony of potential discord. And that's what the market was expecting to see, right? There's a constant push from those countries that have invested heavily in having a much greater capacity than their headline number under the OPEC Plus agreement to rattle the cage and wish to export more. And if those very same countries are seen making supportive noises following the convening in Saudi Arabia, then I guess the market took heed of that. Now, I must confess, I'm quite surprised to see the market up $10 on that alone, and I don't think that's the only reason. I think we do need to focus on the hurricane that's currently, with no need to sort of talk in terms about those that are about to come into the path of it, but it's heading for the Yucatan Peninsula, and it's going to be in Brownsville, Corpus Christi, by all accounts, with pretty accurate tracking at the weekend. This storm weakened over Jamaica, where it did a lot of damage and has strengthened to Category 3. That is a serious storm, but what people are taking much more seriously is that there has never been a Category 5, which this one was. Beryl was a Category 5 before barreling into Jamaica this early in the season. It was the 1st of July, and that is very early, and the reason is that ocean surface temperatures in the Caribbean, in the kitchen for hurricanes, if you like, to the east of Barbados, Grenada, is way, way warmer than it's ever been. And this, of course, has the tongues wagging about the prospects of a very, very busy hurricane season that will cause operational disruptions. Now, depending on
what amount of oil production would be under risk there in... Well, not this weekend, but on general in the Gulf of Mexico, any given storm?
You look at production, you look at refineries, right? So the track of the hurricane is tracking over the north of the Yucatan Peninsula. That is a significant production zone for the heavier Mexican grades of crude. There's only one refinery anywhere close to there. Most of the Mexican refineries are much further to the west. But then the prospect of the hurricane barreling into Corpus Christi is all about how much the hurricane weakens or strengthens as it tracks across the western Gulf of Mexico, and hits the Corpus Christi center, which is a significant refining center. So the harm to production now and the precautionary shutdowns in Mexico are bullish high sulfur crude. In a couple of days' time, there'll be shutdowns of refineries because the track of this particular hurricane is well to the west of most of the offshore producing regions in the Gulf of Mexico, which are pretty much off the Mississippi Delta, and therefore are likely to cause more excitement in products. And you've almost had a correlation between products cracks and the category severity of this hurricane. When it was a Category 5, the markets got the most excited. When it weakened to a lower degree on the Saffir-Simpson scale, the products cracks took a breather. So given that most of the news will be over the weekend when markets are closed, Monday could be interesting.
Christoph, when you look, we hear Mike talk obviously a lot on that comment around the supply side and the OPEC Plus decision, the Gulf of Mexico hurricanes. Where are we on the demand side, Christoph, do you think, going into the third quarter? The idea that we're going into an easing cycle with the central banks around the world, and will the Fed or won't the Fed join that? But ultimately, based on the outlook for weaker economic activity, or is it just because inflation is coming off and that the cuts in rates is not a reflection of weaker economic? I'm trying to get a sense of where GDP growth and demand outlook looks like to you.
The answer to global GDP growth every year is 3%. So just the matter is always just where it takes
place. The question might change, but the answer remains the same. I suppose the question on that might be most interesting, as I asked somebody earlier in the week, is China going to 3%, and what would that be like? And he said that would be a disaster. But sorry to interrupt your answer. Yeah.
No, it's fine. It's not even that would be a disaster. I think the music really, when you look at oil prices, the music clearly plays on the supply side. I agree with Mike. We had this corridor for a long time, which reflects on the demand, stability on the demand side, about which I'll speak in a second. Things which threw us out of the corridor up or down were big events, OPEC meetings, geopolitical events, hurricanes. And I would add one thing to what Mike has said on the supply side. This is the very beginning of the hurricane season. And everybody realizes with all these wildfires, heat waves, and things we have seen, that this very severe storm at the very beginning, so early, may be a harbinger of a change in the frequency and in the volatility of the storm season. And that had the potential to lift the corridor up a little bit in which we move, in which these up and downs of particular threats to refineries take place. So that is one important extension. And I think people are sensitized to changes in the weather to the extent that this could play a role. And come to your question on the demand side, we have a surreal picture because we have probably the biggest gap ever in demand forecasts by those few agencies who still do forecasting, and particularly the IEA and OPEC. I think the spread is now still between 2 point something, 2.4 and 1.1 or so. A huge gap.
It's a million barrels a day gap of demand growth forecast between the IEA and OPEC plus, or
for
OPEC
this year,
actually, not OPEC plus.
More than a
this year,
million,
which is half elapsed. Yes.
Yeah,
Yes,
for this
exactly,
year,
for
which
this
is half
year.
over. So this will be very interesting to see how OPEC gets itself out of that forecast. I don't know what happened there, but this is not going to happen, 2 point something million. And I think what most others have given up on forecasting and do scenarios instead, which makes for a rather dull discussion because everything can happen. What we see on the ground when you look at economic growth is in the US, as I argued earlier, a soft landing, probably a little bit lower growth rates than what we see in the last 2 years. In China, stabilization. I don't think it will fall to 3, but even that wouldn't be the end of the world. It will settle somewhere around 5, and China, that will actually be good for China because it will force the government into some sort of action, and hopefully in some action towards deregulation and liberalization, not just toward exporting the way out of trouble, even though that's how it looks. And I think what this implies is that we have a fairly stable oil demand in front of us, 1 million plus minus 100, 200,000 barrels again. And this settles each other in a long chain of years where we had that with some big events like COVID, obviously outliers. But it also brings us back to a situation where when we look at the data more closely, we don't only have a fairly steady development of demand growth in the world, we also have a fairly steady improvement of the efficiency with which this oil is used. So how much GDP can be supported by that demand growth? And that stability, which we have since the late 70s, we argued that case before, will lead us straight into a forecast for peak demand being reached within that decade. And that sometimes we lose sight of in this argument. That's the real interesting question on the demand side, not whether this year is some absurd 2.4 and some more realistic 1 point something. But if it steady as she goes, if this continues only a few years later, then we will see, and I shouldn't probably say peak, but a plateau of demand because it's a very steady development. It will not be like a mountain falling off, a cliff falling off at the other side. It will be a plateauing, and that plateauing then, of course, will, in the medium term, put pressure on prices.
Mike, just picking up on that, I mean, again, we just noted at the beginning of Christoph's comment there, this disparity between OPEC plus and IEA, and clearly it feels like, given the current half year already done, we're likely to be more in line with the IEA 1.1 than the OPEC 2.2. But in either case, looking ahead, Mike, the third quarter, I see that beautiful map of China behind you. Where do you see China? Can China roar back to anywhere close to, I mean, never mind the OPEC numbers, even meeting the IEA numbers now might be a little bit of a challenge?
No, I don't agree the IEA numbers are a challenge. I think the consensus amongst market participants and banks heavily involved in the sector are still clustering around the middle between those two numbers, so mid to high 1.6, 1.7 million barrels a day year on year. The messages from China in terms of what real-time data is available have actually shown a slight uptick in demand in recent weeks, which really just unpicks the disappointing downtick in demand we saw a couple of weeks prior, so in the middle of June. But as such, that was an end of a worrying downtrend in Chinese demand. And even though economic indicators out of China still typically are bearish rather than bullish, we have to remind ourselves that the Chinese market is still growing. There's so much talk about electric vehicle policy and taxation of vehicles into economies in the West. But the combustion engine sales are still on the up in China also. There just happens to be a lot going on in terms of vehicle pricing policies and international trade in cars made in China. And the numbers look particularly interesting on diesel, which has been holding up as a product. And then, of course, boosted by the hurricane, as I mentioned a few minutes ago, when it was barreling across at 5, right, on the scale. So we must never forget China is not as dependent as it used to be on international markets and has a self-sustaining domestic economy. I was there a few days back. I'm flying there again tonight. The cities are busy, right? My guys are telling me the equivalent of the PMIs, the indices on the state of the manufacturing sector are hovering at numbers that are not too disappointing versus expectations. So I'm not sure
but
how
ultimately,
much
looking forward, Mike, the China's ability to export their way to growth as a model is clearly ending. It's not only ending out of their own choice, perhaps, but also with the increasing scales of sanctions and duties that they're facing at 100%, for example, on EVs going into the US. That the exporting model as being the sort of the source of that incremental demand growth that we've seen for 20 years now, that's coming to an end, no?
Yeah, I guess that's what I was getting at. The Chinese dependency on the containers across to Long Beach or across to Europe is not what it used to be. China has a very great capacity to sustain its own economy based on domestic consumption. And of course, a growing services sector, et cetera, et cetera. So yes, the demographics aren't there to fuel the population pyramids. The bulge is in the middle somewhere, not at the younger generations, thanks to the one-child policy. But my guys aren't too downbeat. They're not coming back from their multiple China visits. I've got a team in China every week going, "Oh my gosh, Mike, it's looking terrible." It's I'm not sure it's going to get much worse. I think that's the mood. Yeah.
Right. And it is, in essence, one of the big floorboards in this $80+ oil price. Obviously, China isn't roaring, but it's doing quite okay. And with the geopolitical risk in other sectors and the OPEC plus cutting, etc., that we have our main floorboards for an $85 oil. Christoph, do we have enough there to propel it up to 90? When we're closer to 90 now than we are to 85. I mean, this is a market that seems to have an upward track in it. Is there geopolitical risk premium in that, or is there one of these fundamentals? Your thoughts on that looking forward?
I mean, there's two different things. One is, I think, what is serious now coming up in the hurricane season is the hurricane risk. And that is a bigger, if you wish, and this is anybody's guess because nobody has ever measured a risk premium on anything. But this is probably more important than the geopolitical risk premium if the situation doesn't change. The other is related to China. Don't overestimate China. Keep in mind, there was a cheap oil supply for them for the longest time from Russian oil, which put them, in a position very advantageous to others and probably will have increased oil demand a little bit more than it would have increased with current global Brent prices. And secondly, the source of demand growth, which becomes important the way it looks like right now, even if China stabilizes, is going to be India in terms of just the growth of it, and to some extent the Middle East as well. So when I put these puzzles together, then still the demand side adds up to a stable sort of 1.1, 1.2, and maybe some people say 1.5, give or take. But the risk premium is what has kept the corridor currently above 80. It's not the fundamentals. If there would be no OPEC cuts and if there would be peace in the world and if there would be no hurricanes, so you can easily envisage
a lot of
40 or 50 because oil supply is plentiful. We should never forget that. So we are talking about constraints which keep prices above 80. Political constraints like OPEC plus, geopolitical constraints like Ukraine and Israel, and wars and then the hurricanes and so on. So if anything, normalization would put pressure on prices. Normalization is not 80 plus. It's below that.
Mike, I mean, looking forward, obviously we're already trading deep into the third quarter and into obviously deliveries into the fourth quarter. Where do you think the OPEC plus decision or OPEC, again, the 8 countries within OPEC that have announced the decision to raise supply by 500,000 barrels a day in the fourth quarter over the course of the fourth quarter, does the market fundamentals look there to support that next step by those countries?
There's the call to be made on non-OPEC production as well. Everyone talks about the very substantial volumes coming out of Guyana and continued investments in the very investment-intensive Brazilian deep water in particular, but also Gulf of Mexico. But to answer your question, they should be happy because, I was tempting fate here because you said we're close to 1985. Actually, that's what it was when we spoke, but you're actually right now because it's printing 87.49. So this is the highest price we've seen since April. So it's gone up 11 cents since I scribbled that when you spoke before. So I mean, $87.50 is a pretty healthy number given the excess supply cushion, or the spare capacity as we call it, that Christoph alluded to.
Do you think that price beds in the fact that they are raising supply coming the fourth quarter, or does it bed in the warning from the Saudi minister when he said, well, maybe we can change our mind? I mean, which of those two do you think the market's betting into that price?
I can't tell you what Vittel's betting because I've got multiple teams who've got different views on this, but my suspicion is they are betting in the announced increase because you look at history and the participants in OPEC Plus have a history in some cases of straying somewhat above their numbers. So there's no reason to believe they're not going to continue doing so and being tempted to. And therefore, the market is definitely not assuming that they'll put less into the market. Participants will only do that if they see a country that's going to struggle to achieve those numbers, whether it's for disruption reasons such as weather or simply the fact that they've been given a generous quota and there hasn't been enough investment, or they're a mature province where some of the African nations in OPEC, for example, have struggled to keep pace with their numbers. I can name a couple, but we know who they are.
Yeah. Christoph, I wanted to wrap up with where we started a little bit, sort of half referencing, but I think it's important to sort of give it a full question, and that is the elections that are taking place. Obviously today, most notably, the UK, there's a landslide victory for the Labour Party with a big majority. Your thoughts on, I know we have the French second round on Sunday. These are big elections in Europe. And of course, the drama, as you referenced, with Biden maybe being pushed or compelled to leave the race there. But what's your thoughts on those elections, particularly the European ones, adding up to something that could be and should be a factor that the energy markets, commodities in general, might have to pay attention to?
Yes, they do. But allow me just one split second to remark on this OPEC, because it's interesting when you look at the communication Mike was referring to. It could have, if you replace oil with dollars, it could have been by the Fed. It is all about being data-driven, looking forward, and then it's like anchoring inflation expectations, saying we can roll them back if these cuts are not worth. And the fact is, markets don't care. They don't buy it. They don't buy the flexibility of oil-producing countries to be the same as that of central banks in a close bracket. On the elections, I think, yes, there is something in there for energy market, and it runs through the economic consequences. Because what we do see is sort of this rise of popularism in Europe and in France. Sunday elections in France will show how big it really is. But these are tendencies which are clearly, in terms of the economics, a right-wing movement, which is big spending movement. So the old borderlines between, say, Labour and Conservatives, where Labour spends on Conservatives is for fiscal consolidation, are being blurred, where everybody agreeing on the left and on the right that the government has to have a bigger role and ultimately has to spend more money on whatever the pet projects are, armaments or climate change or other pandemic fights or whatever it is. And what we've seen in the UK is a bit of an outlier in terms of the shift to the left. But as you and I have just discussed before this podcast, it is also a function of the electoral system with the first through the post, just distorting the numbers a little bit. What we're seeing in the UK and in Europe, and I would argue in the US, is this tendency towards bigger government involvement, bigger government spending, and bigger deficit spending, Germany is once again like an island in all of that when they still stick to this constitutional device of having a balanced budget, but nobody else does and nobody else is planning to do. And that surely stokes up trouble in terms of large debt overhangs, fiscal deficits, and inflation. And then a second round of interest rate tightening are probably much more severe than what we have just gone through. And the background is already weak growth in Europe. And if you look at the European bureaucracy, this is going to be made worse by these diverse election results, and growth slowing in the US. And also, the economic policy, which is about, is sort of full of sanctions and all that, very little constructive policy there. And so that opens a door to the Indias and Chinas of this world to continue to close the gap against the collective West, as Mr. Putin likes to say.
Mike, just last word to you on that. Not wanting to ask you to get into the weeds of the politics of this, but one of the big factors in the energy markets over the last year that hasn't really sort of arrived has been the scale of the sanctions on Russian exports, on Iranian exports. They haven't been curtailed. Iran is exporting more than it has in 5 years. But your thoughts, Mike, on the possibility that with these election results, a more right, though in England it's more moving to the left, the UK to the left, but your thoughts, the election results having some bearing on how these sanctions are implemented and whether easing or strengthening and relevance to the energy markets? You had said earlier not much relevance.
Yes, in my view, the trend to the right in Europe is unlikely to change the degree of support for Ukraine and the negative sentiment towards Russia. You saw Brussels last week come out with a further step of measures to make it very difficult for European headquartered firms to allow supplies to Russia via their non-European affiliate organizations. And you also saw a couple of destination countries in Asia that were happy to take Russian origin blended barrels from places like the Middle East into their operations, cease to do so on the basis that the banking channels and maybe their conscience make it a bit more difficult to do so. And the second thing that's happened is there's a lot of talk now around the Russian LNG, which has been exempt in order to stop fueling the more volatile of the energy commodities, namely natural gas, in Europe in particular. And there's a perception now that there'll be a point reached at some point where not allowing Russian gas into those markets will no longer have the inflammatory effect that it used to have. So those two measures are significant. They're causing a change in behavior, but they're probably just going to drive those flows into the hands of companies that are willing to do it, that have no nexus with Europe whatsoever, and possibly onto cheaper shipping, which brings with it a fresh set of concerns on quality of the global energy transporting the oil tanker fleet. So I think it's a hiccup, but markets have shown over time that oil finds ways of flowing to markets. But there'll be new players, new entrants, and there might be the odd hiccup here and there, and there'll be plenty of oil on the water, I suspect.
Well, we'll have to wrap it up there. The last month in review ahead of the big summer break, the Brent crude oil trading 87.50, as Mike points out. Any producer in the world's going to be happy with that number. Consumers, well, we'll have to see whether it has any upward pressure on that resistant inflation. I just saw a headline pass as we were wrapping up that the U.S. economy has added 266,000 jobs last month, which would indicate that maybe they won't be rushing to cut rates in September as the market has built in its expectation. The world will be changed, I think, by when we next come back with Mike and Christoph in early September. We might have a president, Kamala Harris, by then, which in itself would be a rather phenomenal historical event. Mike Muller, thank you so much. Have a great summer with all your travels. Be safe and enjoy. Christoph Ruhl, amazing as always. Thank you, guys. The beginning of each month isn't the same without you, but I'll get through August. I will. Thanks, guys. Have a great summer. All the best.
Enjoy the heat in the desert.